Hey traders, welcome back to the video online course where we're going to talk. In today's video, we're going to talk about options premiums, strike prices, and expiry dates. In the current screen, you can see my Derby trading platform. I'm trading here options with Ethereum. And let's start with the basics, the options chain. The options chain window. Here we can see on the left side, we can see calls, and on the right side, we can see puts. Basically, trading options, we have these two types of options contracts, calls and puts. We buy or sell calls, and we buy or sell puts. We can apply them in different trading situations. Now let's start with the basics, with the options chain window. Let's start with the date. So today, when recording this video, it's March 13, 2023. When trading on Derby trading platform, we can trade 1 day to expiry options, 2 day expiry options, weeklies, and monthly. They are also called quarterly, but these are monthly. Well, they are quarterly because they expire once in a quarter, like March 31st, June 30, September 29, and December 29. They will be quarterly, but they are also monthly. Let's say we're gonna choose. I will show you an example with March 31. It is 17 days to expiry. That would be a monthly options contract, also a quarterly, but in our case it doesn't matter. It doesn't mean much at this moment. It's how many days there are left till the expiry. That's more important at the moment. And also we can see that the Ethereum right now is trading at the price $1,580. That will help us to understand what is happening and how to construct our options trades. For example, one of the trades I like the most is the so-called covered call trade, which would mean buying 1 Ethereum, paying this price. We would need to buy Ethereum on some crypto exchange, like I am using Coinbase for buying crypto and Ethereum. And for example, we could buy 1 Ethereum at the moment, paying $1,578 per coin. Additionally, we could sell 1 call option with a strike price, let's say $1,600 and expiry March 31st. It's 17 days from today. And if we would sell such a contract, we could sell it for about 74 or 71, about some $70, or as we are trading crypto on the Derby trading platform, the thing is the crypto options are settled in crypto itself. We wouldn't receive $74. Instead, we would receive 0.0475 Ethereum, which equals at the moment $74. If we would go with a covered call option and we would buy in the open market Ethereum paying this price, we could sell, let's say, 1,600 strike price and receive $74. We would click on the double click here and we would construct our trade, saying, okay, I'm gonna sell this call option, which then would mean what would happen next. If we would click sell, we would instantly get paid this price, or more precisely this price, how it would fill up, but we would get this premium instantly. It would be added to our account, and then we would need to wait for the March 31st expiry to see what happens next. And there are 2 scenarios what can happen next. So if we are selling this call option, the strike price could, the best for us would be if the strike price would stay under $1,600. If so, the options would expire worthless and we would keep the premium. or it would be about 4.5, or it would be about 4.5% yield in just 17 days on our total investment of this amount of $1,577. Or the other thing, or the second thing that could happen, the strike price, the Ethereum price could actually go up above our strike price, which would be, let's say it could go, let's say 2000. That would be about 400 above our strike price. Then we would be a little bit troubled, because these options are settled in crypto itself, unlike in the stock market, where if selling a covered call and your shares get called away, you would just deliver your shares and you would get back cash. In crypto, these options are settled in crypto itself, which means we would need to pay the difference in crypto. And the difference which we need to pay would be the difference with the price at the expiry and our strike price. In our example, our strike price is 1600, and say something very good happens to Ethereum, the price skyrockets to 2000 in the next 17 days, which is not impossible, but which is most probably not gonna happen, but it's not excluded. We're gonna talk more about how to construct strike price in some of other videos. I will briefly touch also in this video, don't worry. So if it expires at 2000, the difference between our price is 400, and we would need to pay this in crypto, which means the difference is 400, and it would be about 0.25 Ethereums we would need to pay in crypto. Or we started this trade with 1 Ethereum, but now we would be left only with 0.75. And it might seem like a loss, but if we would multiply it by the new price of 2000, it indeed would be a small loss from our initial investment, as we invested $1,570. We would be left with just 1,500. We would actually lose 70 or $80. Well, this is just the worst case scenario with the covered calls. When recording this video, my aim is not like showing how can you lose money by selling call options. So this is an example with like what can happen selling covered calls. Now let's see if you feel that you are not willing to sell, but you are like looking for buying an options, which is something I'm not doing. Instead, I'm more like a options premium seller. But anyhow, let's say today you see this price for the Ethereum is 1,578, and you have a good feeling that in the next 17 days it could go above 1,600. You could buy this option, paying this price in Ethereum. The good thing, you wouldn't be required to deposit 1 Ethereum. You would be just enough with this margin account with this collateral to deposit it on your account. It's or those about $70-80, and you could buy this option, which then would mean that in case, again, two things could happen. Either on the expiry date, which is March 31st, these options could expire. The Ethereum would trade under our strike price 1,600. Then you would simply lose the money you have invested buying this call option. But if it would go above, let's say if it would go to the same 2000, If the Ethereum price would go to 2000, then this would be the price difference you would receive as additional premium, or in our case it is, we already know it's 0.25 and times 2000 in US dollars, you would receive about $500 back to your account, minus the premium you paid. The premium you paid was like, you would be left with about you would be paid anyhow. You would be paid in Ethereum itself or in crypto if you prefer trading Bitcoin, for example. So this is how basically how it works. These are three components we need to understand: the expiry date, the strike price, and buying or selling call or put options. Put options. Now let's touch the put options. Put options would mean that let's say, again, we see this Ethereum is trading at the same price, 15,078. We could sell or buy. Let's say we feel bearish regarding Ethereum, and we would say, I feel that Ethereum is gonna drop significantly. Let's say you have this feeling that it's gonna drop down to 1,000 or whatever the price. You said, okay, I'm ready to buy the 1,500 put option, which would give you the right to sell back, which would, in case of the Ethereum going under 1,500, you would make profit. Again, but you need always check the break-even price. For example, today we could buy this 1,500 put paying $52 or 0.0335 Ethereums. We would need to Ethereum fall, I would say, at least to 1,400. And let's see let's make some quick calculation. Let's say, so there are two things that can happen. For example, we bought this 1,500 Ethereum put strike, and on the expiry date, which is still this March 31st, the Ethereum is trading above 1,500. Then our options expire worthless, and we lose the premium we paid. We lose these $52. This is the worst case scenario that could happen to us. We lose the premium we paid. But let's say the Ethereum falls down to 1,400. In such case, we would earn the difference between the strike price, which is 1,500, and the spot price, and we assume it's going to be 1,400. It is 100. We would divide 100 to our strike price, which would be about, we would earn about 0.0666 Ethereums, which is quite enough to make us in profit. If we would take it, convert it back to the US dollars on the expiry date, if it's trading at 1,400, we would actually make $93 minus premium we paid at the start. And the premium we would pay, it's like 0.0335. We would take off, subtract this, we would earn 0.03. Let's say we would earn 0.03 Ethereum times 1,400, $42 return on of our investment. That's quite good. Also, we can sell put options with Ethereum on Deribit. We can sell also on a Bitcoin, not only on Ethereum, but that's something I am not really recommending because it can get very dangerous. I do sell put options, but I use some other technical indicators like deltas. I use delta, mostly I rely on delta. And as promised, I said I will briefly touch some technical indicators in this video, but I will make a separate online course for technical indicators, like for deltas, gammas, vegas, thetas, etc. in some other course. But when I'm constructing a trade, I am like looking for deltas to be under 20, 0.20, which also is not very safe. I am okay going with deltas under 0.10, for example. And also I am not recommending trading 17-day. Like, it's okay trading 30 to 45 days to expiry options contracts because of the theta effect. We're gonna cover that definitely in a separate video, but for this video let's just stick with those 30 to 45 days expiry contracts. And yes, so we can see perfectly fine there is 45-day till expiry contract, and I do actually have one contract with Ethereum set to expire with 1600 strike price and expiry on April 28, or about 45 days from today. And my strike price, the Ethereum is trading slightly under the strike price. In fact, a few minutes ago it was a little bit above 1600, and most probably I will get troubled with this contract, and I will need to adjust this trade, like buying back the contract and most probably selling higher strike price with further out expiry date, like I don't know, May or June. But I still have some time and I'm not yet adjusting the strike price. To briefly recap this video about premium, about strike and expiry, these are three basic components when buying or selling options with crypto, and also of course with stocks. We set our strike price. We can see the strike price is here in the middle on Deribit, but it looks mostly the same on most of the trading platforms. The strike price we choose either calls or puts. Then we choose the strike price. We choose our strike price based on the date, and it would be depending on our goals, what we're looking to achieve. We choose the strike price accordingly. Say we could go with, if we would decide to invest this $1,580 in Ethereum, we could also sell, let's say not so aggressive, selling this 16. That would be quite aggressive, but if we would stick with some delta under 20, let's say this delta 16, that would be still quite okay, and that would give us a strike price of 2,000, and we would receive a premium of about 0.0165 Ethereum, or about $26 US. $26 US on 1,500 for 45 days. Well, depending on your goals, are you like a conservative trader and you are not looking for a quick buck, you just hold your Ethereum and you want to gain some additional income, that would be quite okay. If you are more like aggressive, you would probably set your strike price lower, thus limiting your upside potential. Okay, so thanks for watching. I hope it explains a lot. Thank you for watching.